Welcome back to the deep dive. We're here to, cut through the noise, look at the sources, and really pull out the key insights for you. Today, we're tackling Zeta Global Holdings Corp. That's ZETA on the NYSE. Our research is pretty extensive: company reports, market analysis, financial data, all current as of September 14th, 2025. We're using a reference share price of $20.35 from September 12th.
Okay, so let's just unpack this right away. We're in this marketing world that's moving fast, right? Beyond third-party cookies, demanding real, measurable ROI. So the big question is, can Zeta Global's AI native platform actually build a lasting competitive advantage, a real moat against the tech giants? Or is it maybe just a target for disruption? Are they going to get outmaneuvered? We've dug pretty deep into the research, and what we found suggests there might be some overlooked value here, despite some significant challenges, of course. But like always, it's definitely not a story without risks.
Yeah, what's really fascinating and what we want to explore for you is this tension. You've got a company sitting right at the crossroads of data, AI, and frankly, the future of marketing. But then you have these critical questions hanging over them about their competitive strength and, crucially, their operational execution. So we'll dig into whether that current valuation, that $20.35 share price, truly reflects the potential, or if maybe there's a gap the market isn't seeing yet.
Exactly. We'll be covering everything: the core business model, who's leading the company, a deep dive into the financials, what the market sentiment is, who owns the stock, and naturally a good look at the risks involved. The goal here is to arm you with the really important nuggets so you feel genuinely well-informed about Zeta. All right, let's dive into part one. We'll kick things off with chapter one: deconstructing the business engine, Zeta's role in the AI-powered marketing revolution. So just to start, what is Zeta Global, really? How do they actually make money?
Okay, so Zeta Global is, at its heart, a data-driven marketing technology company. You'll hear the term MarTech a lot. Their core product is the Zeta Marketing Platform, or ZMP. It's proprietary, cloud-based. And their whole aim is to simplify modern marketing for big companies, for enterprises. They do this by unifying identity, intelligence, and activation across all channels, all in one place. Revenue-wise, it's mostly SaaS-based. Think platform subscriptions, services, that's about 85–90% of their total revenue. And then they also have some managed services and data analytics rounding it out.
Okay, a platform model. But what about their main product? You mentioned the ZMP. What makes it stand out?
Right. The ZMP is the big one. It's AI-powered omnichannel. A really crucial piece within it is their customer data platform, the CDP plus DUS. That's what unifies all of the customer data, gives clients that single complete view of a consumer, which is, essential these days. But I'd argue their crown jewel, their most significant asset, is probably the Zeta Data Cloud.
The data cloud. Tell me more about that.
This isn't just like a regular database. It's massive. It's built on permission-based profiles and signals covering over 2.4 billion consumer identities globally. And it's deep data too: demographic, behavioral, transactional info. Each profile has something like over 250 distinct attributes. That sheer scale is what really enables hyper-personalization for their clients.
Wow, okay, 2.4 billion identities, over 250 attributes each.
Yeah.
It's not just scale. That sounds like a serious data advantage. How much of the competitive edge really comes down to the specifics of that data cloud, and where does that place them in the market?
That data cloud is absolutely central, yes. It's a huge part of their moat. They serve over 450 what they call scaled enterprise customers. These are clients generating over $100,000 each annually. They've got a global team of about 2,200 people, market cap around $4.84 billion. So they're definitely established. Their core value prop isn't just selling software tools. It's about empowering these big companies to acquire, grow, and keep customers more efficiently. And critically, delivering measurable ROI. Their big claim is pretty bold. They say they can cut a client's cost to create, maintain, or monetize a customer by as much as 50%.
50%?
Yeah, by consolidating everything onto their all-in-one platform instead of using, a patchwork of different tools. That 50% number is a very powerful pitch.
I'll bet it is. Okay, so that's Zeta itself. Let's zoom out a bit. What about the wider MarTech industry? What trends are driving things there?
Oh, the MarTech space is absolutely booming. Projections put it at around $558 billion in 2025, and it's expected to grow at nearly 20% CAGR through 2034. It's massive growth. The key drivers are pretty clear. First, the big shift to first-party data as third-party cookies finally fade away. Everyone needs their own data now. Second, this huge demand for hyper-personalization, but at scale, which really requires AI. And third, you see this ongoing convergence of MarTech and AdTech. The lines are blurring. And within that, the specific market for customer data platforms, CDPs, where Zeta is strong, especially in the US, is set to grow at something like 26.6% CAGR through 2033. So they're riding a very strong wave.
That growth is undeniable, but you've got giants like Adobe, Salesforce, Oracle playing in this space. Isn't Zeta kind of swimming with sharks here? How do they expect to carve out significant share, especially with all the regulatory stuff around data privacy like GDPR and TCPA?
That's a fair point. The competition is absolutely fierce. But interestingly, the whole data privacy scrutiny, it actually plays to Zeta's strengths in a way. Their entire model, remember, is built on permission-based first-party data, so they can position themselves as a privacy-centric partner, which is becoming a bigger and bigger deal for enterprises.
Ah, okay, so the regulations might actually help them differentiate.
Potentially, yes. As for their competitive edge, their moat, it's built on a few things. First, just replicating that data cloud, 2.4 billion identities, trillions of signals built up over a decade that's incredibly hard and expensive for anyone else to do from scratch. Second, their tech architecture is AI native. They started building it specifically for AI back in 2017. That gives them theoretically an advantage over older legacy systems that are trying to sort of bolt AI capabilities on later.
Right, built in versus bolted on.
Yeah.
Makes sense.
Third, there's this powerful data flywheel network effect. Every campaign a client runs feeds back into and enriches the data cloud. This makes the predictive model smarter for all clients. It's a virtuous cycle. The more clients use it, the better it gets for everyone. And finally, once a company integrates deeply with the ZMP, the switching costs become pretty substantial. It's sticky. Their One Zeta strategy pushes clients to use the platform for more things, acquiring customers, growing them, retaining them across more channels. The goal is to capture a bigger slice of each client's marketing budget.
Okay, that gives us a really clear picture of the business and how they're trying to defend their turf. Data and AI are clearly key. Let's shift gears now into the next part of Part 1, Chapter 2, evaluating stewardship, management, and capital allocation. Who's actually leading Zeta? And how have they, handled tough times?
The company is led by co-founder, chairman, and CEO David A. Steinberg. He's a serial entrepreneur, got over 30 years of experience, scaled 5 tech companies before Zeta. So he's got history. The rest of the executive team brings experience from places like Bain & Company, IBM, so there's pedigree there. A really major test for them came in November 2024. A short seller, Culper Research, put out a report alleging things like revenue round-tripping and using improper consent forms. The stock absolutely tanked, dropped 37%.
Wow, 37%. How did management react?
They reacted very quickly and very aggressively. They immediately refuted the claims, brought in forensic experts, published reports. It was a real case study in crisis management.
That short seller report sounds like a massive stress test.
So,
Okay, they refuted it. But what's the main takeaway for investors from that whole episode? Does it show management's strength under fire, or maybe point to a lingering perception issue?
I think it primarily highlights their agility and their commitment to transparency, frankly. They've built this reputation for consistent execution. You often hear about their 16 consecutive beat and raise quarters as of Q2 2025. That kind of track record builds a lot of credibility. But you're right, that short seller report, even though refuted, does leave a bit of a shadow, a reputational overhang. It means the market's probably watching them even more closely now. The pressure for perfect transparency is definitely higher.
Makes sense. Okay, let's talk about how they use their money. Capital allocation. Are they reinvesting heavily in growth, or are they returning capital to shareholders?
Zeta's growth approach is really a mix of organic investment, building out their platform, and strategic M&A, especially early on. They acquired 9 companies initially to kind of piece together the platform foundations. More recently, they bought Live Intent in October 2024 to boost the ZMP and the data cloud. Now, being a growth company, they don't pay a dividend. That's pretty standard. Instead, they've been quite aggressive with share buybacks. They just finished a $100 million program and immediately got approval for a new $200 million one running through December 2027.
Why focus on buybacks?
Their stated goal is net zero dilution. They issue a lot of stock-based compensation, or SBC projected at $190 million for 2025. So the buybacks are mainly to soak up those shares and prevent existing shareholders from being diluted too much. And as a strong signal of alignment, key execs, including the CEO and CFO, actually gave up their 2025 equity grants.
Yeah, that is a strong signal. But are these investments, the M&A, the R&D, actually generating good returns? What's their return on invested capital, the ROIC, telling us?
Well, as you expect for a company investing so heavily in growth, their ROIC has historically been negative. That's pretty typical. But the trend is what's really important here, and it's improving dramatically. It went from like -75% in 2022 to about -41% in 2023. And for the latest 12 months, it's hovering between -2% and -4%. So that strong positive trajectory suggests they're getting much more efficient with their capital. capital, they're steadily moving toward actually generating returns above their cost of capital, which is, a critical milestone for any growth story.
That's a really interesting turnaround on the ROIC. Okay, fascinating look at management and capital. Let's get into the final piece of Part 1, Chapter 3. A forensic look at the financials, growth, stability, and value. For listeners trying to gauge Zeta's financial health, what are the absolute key numbers, the must-watch indicators?
Okay, let's dive into those financials. As we mentioned, Zeta Global's market cap is around $4.84 billion. The big story here is revenue growth. It's not just strong, it's actually accelerating. They went from $368 million back in 2020, crossed the billion-dollar mark in 2024, 1.006 B. And for the trailing 12 months ending June 30, 2025, revenue hit $1.16 billion. That's a 40.6% jump year over year. This high growth profile is absolutely central to the whole investment case for Zeta.
Okay, impressive top-line growth, but is it translating to the bottom line? Are they actually making money yet?
Not quite on a GAAP basis. No, they're not yet GAAP profitable. But look, their margins are definitely heading in the right direction. TTM gross margin is strong at nearly 61%. Operating margin is improving, now at negative 1.32%. Net margin is also getting better at negative 3.16%. But maybe the most compelling financial metric right now is their free cash flow, or FCF. It's growing rapidly. It was $55 million in 2023, then it jumped 67% to $92 million in 2024, and their guidance for 2025. Between $140 million and $144 million, that's another, 54% increase year over year at the midpoint.
Wow, that FCF growth is really eye-catching. That signals a pretty healthy underlying business, doesn't it?
Exactly. That strong FCF generation is crucial. It's kind of the proof point that the business model works and can eventually be very profitable.
So, strong FCF. How solid is the overall financial foundation? What's the balance sheet look like? Are they stable?
Yeah, their financial stability is actually a key strength. They're very conservative with debt. The debt-to-equity ratio is only 0.29. And importantly, they have more cash on hand than total debt. So they're in a net cash position, which is great. Their current ratio, which measures liquidity, is exceptional at 3.25. So they can easily cover short-term obligations. Now, yes, they've had a history of GAAP net losses, but as we said, those losses are narrowing significantly, and analysts are actually projecting them to hit full-year GAAP profitability in 2026. That would be a major, major inflection point for the company and how the market views it.
Right, turning GAAP profitable is a big psychological milestone. Yeah. Okay, so you've got this high-growth company, strong SCF, improving margins, solid balance sheet.
Yeah.
How do you value something like Zeta? Traditional metrics seem tricky.
You're absolutely right. Traditional PE based on trailing earnings isn't really meaningful because of those past GAAP losses. Their forward PE, based on analyst estimates for future earnings, is around 27.3, which gives you some perspective. Price to sales is probably more relevant for comparison right now. On a TTM basis, it's about 4.20, but for getting at intrinsic value, a discounted cash flow or DCF model is really the way to go.
Okay, DCF. What are the key assumptions you have to make for that kind of model with Zeta?
Sure. The big ones are revenue growth. We assume it gradually slows down from the current guidance of 25% for 2025, eventually settling at a 3.0% terminal growth rate over a 10-year forecast. Then there's the discount rate, the WACC weighted average cost of capital. Given their stock beta of 1.31, which indicates higher volatility than the market, we used a range of 10% to 12%. And finally, free cash flow margin. You project that expanding from the current guidance of around 11.2% for 2025 up to a more mature state level of 16% to 20% over the long term.
Okay, plugging all those assumptions in, what does the DCF model suggest Zeta's stock is actually worth intrinsically?
Based on those assumptions, and remember this is an educational analysis, the DCF model yields an estimated intrinsic value for Zeta shares in the range of $22 to $28 per share.
Okay, $22 to $28, that's a really helpful range. We've covered a ton of ground in Part 1, the business, the management, the financials. Let's move into Part 2 now, starting with Chapter 4, gauging the market's mind, sentiment, and technical indicators. What's the general feeling on Wall Street about Zeta? Are analysts bullish, bearish, somewhere in between?
Analyst sentiment is overwhelmingly positive, actually. It's a pretty strong consensus. You're looking at moderate buy or strong buy ratings from, depending on the source, 11 to 16 analysts covering the stock. Their average 12-month price target falls somewhere between $27 and $30.14, compared to the current price, around $20.35, that suggests, potential upside of 33% to 48%. And recent news has definitely helped that sentiment, things like hitting their 16th straight beat and raise quarter and announcing that new $200 million buyback program. But as we keep mentioning, that shadow of the November 2024 short seller report is still there. It definitely contributes to some level of underlying skepticism in the market despite the positive analyst views.
You mentioned skepticism. Are there other market signals, maybe beyond the analyst reports, that show if there's significant doubt or maybe hidden bullishness?
Yeah, there absolutely is significant bearish sentiment, and you see it clearly in the short interest figures. Somewhere between 11.5% and 15.5% of Zeta's publicly available shares, the float, are currently sold short.
That seems high.
It is high. It's higher than the average for their peer group, which is around 12.7%. So this creates a really polarized situation. You've got bullish analysts and a heavy short presence. It means there's potential for increased volatility. And, it also sets up the possibility of a short squeeze if the company keeps delivering positive news and the stock price starts moving up decisively. Shorts might be forced to cover, driving the price even higher.
Interesting dynamic.
Yeah.
What about the technical chart picture? Any signals there?
From a technical standpoint, the picture looks positive currently. The stock is trading above both its 50-day simple moving average, which is around $17.38, and its 200-day simple moving average, around $15.06. Generally, traders see that as indicating positive momentum in both the short and long term.
Okay, so mixed bag on sentiment bullish analysts, high short interest, but positive technicals. Let's shift now to Chapter 5, the ownership ledger. Who holds the power? Who actually owns Zeta Global stock?
Well, institutional ownership is very high. We're talking about 87.8% of the shares being held by institutions like mutual funds, pension funds, hedge funds.
That's a big number. What does that usually signify?
It typically indicates strong conviction from sophisticated investors, often those with a longer-term horizon. You see major players like the Vanguard Group holding over 10%, BlackRock with nearly 8%. This usually provides a stable ownership base. It's also fairly concentrated ownership. The top 10 institutions own more than 38% of the company.
Okay, so the big money seems to be on board. What about the insiders, the people actually running the company? Are their interests aligned with shareholders?
That's always a critical question, isn't it? Insider ownership is quite significant, somewhere between 13% and maybe just over 20%. The CEO, David Steinberg, personally holds shares worth over $72 million. So he definitely has skin in the game.
Right, but we often hear about insiders selling. Are they buying or selling more recently? Especially thinking back to that short seller attack.
That's where it gets really interesting. Over the last 12 months, insiders actually made 24 open market buys compared to 16 sells. And even more recently, in the last 3 months, it was 6 buys versus only 1 sell. But the most telling action was back in November 2024, right after that short seller report hit and the stock plunged. There was a significant cluster of insider buying. The CEO, the CFO, others stepped in and bought shares on the open market. That was seen as a very powerful vote of confidence exactly when the company was under attack. It signals strong belief from those who know the business best.
Yeah, buying into that kind of weakness definitely sends a message. Okay, it's clear key stakeholders are invested. Now, let's move to a really crucial chapter, Chapter 6, a prudent assessment of risk. Time to break down the SWOT analysis, strengths, weaknesses, opportunities, and threats for Zeta.
Absolutely. Let's lay it out. Strength, we've talked about the advanced AI native ZMP, that proprietary data cloud moat, the strong and accelerating growth, their clear path towards GAAP profitability, and that solid financial footing, low debt, high liquidity. Those are big positives.
Okay, what about the flip side? Weaknesses.
Weaknesses. Well, the history of GAAP net losses is still there. The heavy reliance on stock-based compensation is a factor. It creates dilution risk if they don't keep up the buybacks. There's that lingering reputational overhang from the 2024 short report. And client concentration is notable. The top 5 customers make up over 42% of revenue. That's a risk if one were to leave.
Right, that client concentration is definitely something to watch. Opportunities.
Opportunities, huge ones. They're in this massive, rapidly growing MarTech market. There's significant potential to grab market share from older legacy systems, lots of room for international expansion, moving into new industry verticals, and they can continue making strategic tuck-in acquisitions to add capabilities to the platform.
And finally, threats.
Threats. The big one is just intense competition. Tech giants like Adobe and Salesforce have vast resources, plus there are tons of smaller niche players. And then there's the ever-evolving regulatory landscape around data privacy. While it can play to their strengths, any major changes could still pose a threat.
That's a great summary. Beyond those direct industry factors, how exposed is Zeta to bigger picture stuff? Macroeconomic shifts, geopolitical events.
They're definitely not immune. Like most companies, performance is tied to the economy. If inflation really bites and erodes consumer spending, clients might pull back on marketing budgets. That's a direct hit. Higher interest rates make capital more expensive and can compress valuations for growth stocks like Zeta, although potential rate cuts later in 2025 could be a positive catalyst. Geopolitically, things like the U.S. tariffs imposed in 2025 could squeeze their clients' profitability, which might then impact marketing spend. And the whole U.S.-China dynamic poses longer-term risks, thinking data localization laws, or a more fragmented global tech landscape, which could make international growth more complicated down the road.
Right. Those macro factors are always lurking. Okay, we've covered an incredible amount of ground: the business, management, financials, market view, ownership, risks. Let's bring it all home now with our final chapter, Chapter 7, Conclusion. Let's synthesize everything into the bull case, the bear case, and what it means for valuation.
Okay, let's sum up the bull case first. It's pretty compelling. You've got Zeta operating in a massive, high-growth market, perfectly positioned to benefit from these huge shifts towards first-party data and AI in marketing. They have what looks like a durable competitive moat, that huge proprietary data cloud, the AI-native platform, that data flywheel effect we discussed. Operationally, they've shown really consistent execution. 16 beat and raise quarters is impressive. Growth is accelerating. They're clearly heading towards GAAP profitability. FCF is booming, and the balance sheet is strong. Plus, you have an experienced founder CEO and significant insider buying, suggesting strong conviction from the top. That's the bull story.
All right, sounds pretty good. Now give us the bear case. What are the major concerns?
The bear case is just as important to understand. The risks are definitely significant. First, that intense competition from giants with way deeper pockets. Second, the history of GAAP losses and that high stock-based compensation, which puts pressure on the share count via dilution unless offset by buybacks. Third, that lingering reputational risk from the short seller report. It just means less room for error. Fourth, the client concentration risk we mentioned. And finally, the inherent cyclicality of marketing spending. If there's a significant economic downturn, marketing budgets are often among the first things cut. Ultimately, the stock's current valuation relies heavily on them maintaining very high growth rates and expanding margins significantly. Any stumble in execution against those ambitious expectations could hit the stock hard.
So putting the bull and bear cases together, where does that leave us on valuation? You mentioned the DCF earlier.
Right. Our intrinsic valuation, using that discounted cash flow model projecting future cash flows, estimates Zeta Global's stock value somewhere in the range of $22 to $28 per share.
Okay, now here's where it gets really interesting for you, our listener. Zeta's share price as of September 12th was $20.35. Our analysis suggests that it's currently trading below the low end of that estimated intrinsic value range. $22, $28. So what does that actually imply for someone thinking about this stock?
It implies potential undervaluation, yes. However, and this is a crucial however, that potential is contingent on management continuing its really strong execution track record and actually hitting those ambitious Zeta 2028 long-term targets they've set out. So you absolutely have to weigh that potential reward, that implied upside, against all the significant risks we've discussed: execution risk, competitive risk, macroeconomic risk. The whole investment thesis really hinges on Zeta successfully making that transition from being a high-growth, investment-heavy company to becoming a durably profitable cash compounding machine. The current valuation reflects the market's assessment and maybe some skepticism about that transition.
It's a pivotal point for them. So here's a final thought for you to consider as you reflect on Zeta's story. In this world where everyone says data is the new oil and AI is the engine driving everything, how many companies out there truly possess both a massive proprietary data flywheel and an AI-native architecture built from the ground up, not just retrofitted? What does that fundamental difference built in versus bolted on AI and proprietary data scale really mean for long-term survival and potentially dominance in this increasingly complex digital marketing world? Is the market fully grasping the value of a true AI-native advantage coupled with unique data assets? Or are we still just figuring out what that means for building sustainable competitive moats in the future? Something to definitely ponder. That was a really comprehensive deep dive into Zeta Global Holdings Corp. We certainly hope you feel much better informed now and got some valuable takeaways. And hey, remember, you can like and subscribe to Stock Analytics AI. Our members, for just €4.99 a month, get priority access to deep dives on the tickers they request.
Plus, over the next few months, we're aiming to cover all of the S&P 500 stocks, and members get exclusive priority access to those too. And if you just want a one-off deep dive on a stock you're interested in, just drop us a super thanks on the platform.
And just the usual reminder, this analysis was generated by an AI system purely for educational purposes. It should definitely not be taken as financial advice. Please, always do your own research or talk to a qualified financial advisor before making any investment decisions. Thanks so much for joining us on the Deep Dive today.